In this video, we're going to apply the lesson on how to compute economic profits to help us understand the decision to open up a business. Now, the framework we're going to use to analyze this decision is going to be very similar to the framework we use to analyze individual behavior, the utility table framework. It's just that while individuals try to maximize their utility, firms try to maximize their profits. And so instead of calling this a utility table, it's more appropriate to think of this as a profit table. But otherwise, they're going to be very similar. Just as we saw with utility tables, we need to start by identifying all of the alternatives. And so let's consider two different types of restaurants that I might want to open up. The first would be, let's call it Mickey's Veggie Burger Emporium. We would sell all different types of veggie burgers. And the second option under consideration would be Mickey's Veggie Pizza Parlor. We would sell all different types of vegetarian pizzas. Now, if we were to go out and conduct a market research survey, they might come back and tell us some important information about how much money they would expect us to make. But their expectations will be focused on the accounting profit, taking our revenues minus the cost of our land or labor or capital. But suppose they come back and tell us that if we open up the Veggie Burger Emporium, that they believe we can make $100 a week of accounting profit. On the other hand, they say that the Veggie Pizza Parlor will likely have a wider audience, and therefore it should generate higher profits, something like $500 a week. So now that we have the accounting profit, let's think about what we need to do to understand the economic profit. Well, remember, once we have accounting profit, all we have to do is subtract off the cost of our entrepreneurship, the cost of that fourth resource. Now, earlier in the lesson, we learned that all the different types of resources need to get paid in order for firms to use them. Land gets paid in rent, labor gets paid in terms of wages, capital gets paid in terms of interest, and entrepreneurship gets paid in terms of profit. Profit that has to be sacrificed. So let's think about this. If I choose to open up Mickey's Veggie Burger Emporium, what profit must I sacrifice? Well, as you might have guessed, if I open up my Veggie Burger Emporium, I'm using all my resources to produce the Veggie Burger Emporium. And therefore, I'm giving up the opportunity to use those resources to make the Veggie Pizza Parlor. And therefore, I'm not going to be able to make that same profit that I could have made. Consequently, if I open up the Veggie Burger Emporium, I must sacrifice the $500 a week of profit I could have made with the Veggie Pizza Parlor. If I open up the Veggie Pizza Parlor, I'm using all my resources to make the veggie pizzas. I'm giving up the chance to use those resources to make the Veggie Burger Emporium and to earn that $100 a week of profit. Notice, the cost of entrepreneurship is really just the opportunity cost that the entrepreneur faces. It's the value of the profit foregone. Now that we have our cost of entrepreneurship, it's rather straightforward to compute our economic profit. For the Mickey's Veggie Burger Emporium, we have an accounting profit of $100 minus a cost of entrepreneurship of $500, gives us an economic profit of negative $400 a week. Likewise, for the Veggie Pizza Parlor, we have $500 a week minus $100 a week of entrepreneurial costs, gives us an economic profit of $400 a week. Consequently, since firms generally tend to act in ways that maximize their profits, we would expect that this firm would choose the Veggie Pizza Parlor. Because as we look at the two options, it's the only option that generates any economic profit. It turns out, and this is an important rule, that no matter how many options you have, there can be no more than one option that generates a positive economic profit. All others must be negative. In this case, that one option is the Veggie Pizza Parlor.